Hi, it's Marc Cormier, and welcome to this week's edition of Marc's Minute. Today, we're going to be speaking to Jeremy Jaques. Jeremy is a CPA with the Jacques Financial Group in Rockville, Maryland. So sit back and enjoy the show. Any comments, questions you have, please leave them below. And on with the show. Jeremy is a CPA. Tell us a little about yourself, Jeremy.
I'm a CPA and a financial advisor. I work in a private practice with my cousin, Bill Jaques, and my father, Joe Jaques.
These are questions that were asked from different clients, and I just figured it would be a great way to put information out there.
Everything Marc and I are about to talk to, it is a conversation. We're brainstorming. We are going to hit on some topics, I'm sure, dealing with a broad range of capital gains issues, sales issues of property and various items. And everything we talk about cannot be taken to apply to anybody else's situation. Because when it comes to taxes, legal, everything is applicable to that individual. So if you hear a topic that we discuss, do not take what was said to apply to you, because the circumstances we're describing are applying to our conversations. So if you truly want advice, I urge everybody to contact a licensed CPA, licensed attorney, licensed realtor, and get a true opinion before making big financial decisions that you will regret for 20 years. These are conversational items. These are not advice for anybody else, but Marc and I's discussions.
Okay, there we go. We got our disclaimer in there. Let's jump right in. Capital gains is always a question people have, and
Always
I guess let's really start out by just explaining what capital gains is.
Capital gains are essentially the government's way of taxing citizens on the appreciation of their assets once sold. Capital gains don't get locked in by just owning something. They get locked in when you sell something for more than you purchased it for. So if you buy a house for $500 and you sell that same house for $1 million, you have a capital gain of $500,000. Now, whether that capital gain is short-term would be if you sold the house in less than 12 months from when you purchased it. Applies to most property. Long-term capital gains is you have to hold the property for more than a year. If you hold that house you bought for 15 months for $500,000, you sold it for $1 million, you have a long-term capital gain of $500,000. Based on your income level, your state, the type of property sold, whether it's personal or rental, a lot of implications go into the exact amount of capital gains you will pay. There's too much information online. It's information overload. TurboTax does not help with complex issues, and you really have to rely on a CPA or a licensed realtor that you trust, because we're the ones that need to guide you and help you understand these big complex decisions, such as selling your home at a gain.
Let's let's clarify. So if it's a residence, they have an exemption, right? That's a federal exemption. What is that exemption?
Mm-hmm. What that is the government wanted to help people with the sales of their home, help people not to be burdened by an overbearing tax code if you sell your property that you hold for a very long time. So they got together and they passed some laws in the tax code that if an individual sells their primary residence, and what I mean by primary residence is they have lived in the property for 2 of the previous 5 years. Okay, that means when you register to vote, that's your address. That's your address on your tax return. That's your address on your driver's license. That's your address on your utility bills. If you own a property that has been your primary residence for 2 of the previous 5 years, and you were to sell that property at a gain, let's go back to our original example. You sell it for $1 million and you've bought it for $500,000. Taking that in a bubble, you would have a $500,000 gain. And if my clients were a married couple filing a joint tax return, they would get a $500,000 capital gain exclusion. So on their tax return, they would report $1 million. I'm doing the math here on my keyboard because that's what I like to do. Minus 500,000, we're at $500,000 gain. Minus, because I would ask them questions. Did you live in the house for 2 of the last 5 years? Yeah, I've been doing their tax return for the last 5, so I know exactly the address that they were used, or I would review prior year tax return. Okay, we have a gain. You're filing a joint tax return, 100,000 minus 500,000, $500,000 gain minus $500,000 capital gain exclusion. No tax consequences from the sale of that for federal or state. Let's say a single individual, same situation. The single individual sells his house for $1 million that they purchased for $500,000. A single individual only receives a $250,000 exclusion. So back to our calculator here, $1 million minus 500,000, the gain of 500,000 minus 250,000. They still have a $250,000 long-term gain because this property has been owned for 15 months. You paid closing costs. When you're going to sell the house, you pay closing costs. Those items add to the basis in your house. The basis is what you purchased it. As do capital improvements.
Yep.
That's not a capital improvement, but that house you bought for 500, you put in a brand new Tesla roof for 50 grand. The basis in that house is 550,000. If you put in new cabinets for 10, 560.
Gotcha.
The rule of thumb is pretty much anything that's attached to the house. If you go to sell your house and your realtor is like, look, it is in such bad disarray, the painting, you can't sell the house. So you have to paint your house to sell it. That is an expensive sale, and you can deduct that painting. Painting you did 10 years ago, that's not an expensive sale. That expensive sale needs to be incurred in order to get the property to market, to sold in the year you sell it. Okay. So that's a big determination of when you're thinking about selling our primary residence is, do I have a gain? What is the gain? Hey, you're selling your house. What is it? Primary. How long have you lived in it? 5 years. What did you buy it for? What can you sell it for? Okay. You're at a $250,000 gain. You're selling the property as a joint filing. There will be no tax consequences on this property since it's your primary.
You said if it's married or if they file individual. But what if it's a married couple that files both individual? Do they both get 250?
If you do a married couple filing separate, they're limited to $250,000.
Okay, good to know.
Yeah.
Because just as a little background, Jeremy and I came across a client who had a house that they paid like 200,000 for, and it's worth like $1 million too. And
I think over that.
yeah, you have to figure them out and look at them before the sale, because after the sale, it's too late. So these are things
you couldn't have put it better, Mark, because Mark and I can't do anything for you after you sold the house, right? So if you made a decision, but Mark, when he realized that situation, he immediately called me up and said, hey, look, I know that there's going to be significant tax consequences. I don't want to move forward with this until me, you, and my client have a complete understanding of what this person is looking into.
It's always a matter of how much a person keeps, not how much it sells for.
Say two important items when it comes to selling your primary residence that I see a lot of confusion in the open market. The first is, and I think this comes from a tax law a long, long time ago, but I get the question a lot is, hey, Jeremy, I just sold my house. My gain was less than 500. Okay. How long do I have to reinvest those proceeds in another house, another primary residence, before I lose the capital gain exclusion? And my answer is there is no timetable.
Yeah.
If you've lived in the house 2 of the last 5 years, you're filing a joint tax return and you qualify for the exclusion, you sell that property and you get net 800,000. You can put that in the bank and just watch it if you want. There's no requirement that you reinvest the proceeds of your primary residence in order to qualify for the capital gain exclusion. When you put in a 20% down payment, that doesn't include transfer taxes and sales taxes. So I've had a situation where the client had just enough for a 20%, but they didn't have enough to cover all the taxes. So they actually have to pay mortgage insurance premiums because their down payment wasn't 20%.
Yep.
So 2 items, just you don't have to reinvest the new proceeds if it's your primary residence, and be aware of the transfer taxes and commissions when you're factoring in if you have enough for the down payment.
That's the primary. Now let's look at the investment side for capital gains. Since we're on a roll here. So now you're selling an investment property that they bought for 500 and they're selling it for $1 million. It was a good investment. They bought it from me. I guided them all the way through. So now tell them what their options are and what the minefields are that they could blow the deal up or make it a worthwhile.
If you sell something at a significant gain, you're gonna pay taxes. Let's focus in on an investment property that you sell for a $500,000 gain. If it is short-term gain, so the investment property that you bought in February, flipped it and sold it for $1 million.
That's a heck of a
10
flip.
months later. heck of a flip, right? Sold it for $1 million 10 months later. Okay. You pay short-term income taxes on the gain, which is sales price minus purchase price, minus commissions, expenses, minus capital improvements, and everything you put into that house to get it to sell. You pay taxes at either a 15% rate, 18.8% rate, 20% rate. Let's just continue this going. If you are in the top two brackets, that's the 35% and the 37% bracket, your starting capital gains for anything, not just home sales, but for stocks too, it's 20%. Plus, if you're in the top brackets, which for married couple starts over 500,000, you have the surtax of 3.8 already. So your capital gain is 23.8 for federal plus normal income for the state. It's another topic that people look over a lot. So if you're in Maryland, 8.5%.
Yeah.
The things though, so I'm sorry, the numbers we just described are long-term. So for
okay.
short-term gains, you pay normal income rates. Your effective rate when you're in the 37% bracket, Mark, it sometimes falls to be about 28 to 31% effective. So it's 31% plus 8.5% for short-term gain. So you pay normal income taxes on that flip. So if you're in the top bracket and you have a property that you're 2 months away from having long-term capital gains treatments.
Let's go back to that same example. 500,000. The parent owns the house, does 500,000. The parent passes away. It goes to the children. The children want to sell it, $1 million. There's a different, the tax code is different. Can you explain that?
Yeah, absolutely. If you were to inherit a property after death, so in the example Mark just went over, your parents or your father passes away and you inherit his property after death, which means only his name is on the title. Okay. Currently, as the laws stand, they inherit that property with a basis. So remember, we talked about the basis, essentially what you purchased the property for, plus all your capital improvements, everything. Those beneficiaries' basis in the property is determined based on the fair market value on the date of that individual's death. So when that individual passed away and their house was worth $1 million, those two beneficiaries, they get the property as if they've purchased it for $1 million, because they get a step up in basis to the fair market value on the date of death. Every time you have an estate, you want to make sure that if there's a property, a primary residence that was sold and inherited, that a qualified appraisal is done, and that is what's used to determine the basis. Okay.
I just had an incident that the client called me. They had purchased the house from their sick mother, and they purchased it before her death. And so
that's a mistake. That's
yes,
one of the mistakes
I know,
that I was
but
wearing for.
Again,
so
it was a call that I got after the fact because she had already passed, and then now they were going to sell it. I'm like, well, when did she pass? I was trying to go through all that, and when I found out it was too late to do anything, and
so in
again,
those situations that you just described, it happened a lot in the past when the death taxes, you hear that term a lot. That used to be $1 million. So people designed estate plans to get around that. That $1 million has gone to over 5 million now. So these estate planning things don't happen as much. But for the situation you described, if you buy the house from your mother or your father, or they gift you the property, you get it at their original cost basis. So if they purchased that property 45 years ago for 50,000 in
that's about what it was,
the highest price area, and they sell for $1 million, those beneficiaries' basis is 50,000. Because the laws change every single year, even in the middle of tax season, they change for what we've experienced. That's why it's always important to talk to qualified professionals before you make a sale. Mark and I can't do anything after the sale is made. We can only help manage the fallout from the sale.
And with that point, it's come to us a year in advance. It's never too early to come.
Nope.
I'd rather be a year too early than a minute too late. There's options, 1031s, there's Delaware statutory trust, there's all kind of vehicles. The one piece I want to leave people with is if you have an investment property and you're thinking about doing a 1031, it's not like property is not like you have to get, if you have an investment house, you have to buy another investment house. You can go from being the landlord on one property to investing in basically REIT almost. there's a plethora of options that you don't have to be an active investor. You can be a passive investor almost. I might be saying wrong tax terms and you'll correct me, but I don't want them to be scared saying, gee, I'm tired of being a landlord. I don't want to be a landlord. I want to get out. Well, you can do that and still get some great returns and keep your money working for you versus sharing it with the IRS.
You put that right. I don't have any major corrections to that. Delve into the topics that you just mentioned and the tax consequences of renting, also converting your primary to a rental, which is also a huge discussion, and then also the 1031.
So now we're talking about their primary residence. They may want to convert it into a rental to capture some capital gains benefits. So why don't you jump into that, talk about the conversion, talk about maybe 1031. What are their options?
Absolutely. So the individual who is looking to convert their primary residence into a rental, very common, especially when people get married and they have their old condos and they bought their joint property together. Okay. The first question is, do I want to be a landlord? Do I want to incur the hassle of getting new tenants, signing leases, getting a call at 4 a.m. when a hot water heater breaks in the dead of winter? Okay. Some of those can be mitigated by the hiring of a management company, but then we're giving away some of our profits. Okay. So the first thing is, do I want to be a landlord? Okay. The question is yes. Then it's like, okay, what are the tax consequences of me converting my primary to a rental property? Well, that answer is it depends. What the IRS says is if you make over $150,000 a year, you are not allowed to take any tax losses on that rental property. They become passive losses that will be carried forward to offset future passive rental incomes, or they will be released in the year the property is sold. So an individual's making $250,000, they convert their condo to a rental. And the first year they rented it, they had a big blow up on their HVAC units and they had to spend $8,000 to replace the main HVAC unit. They come to me, say, hey, Jeremy, the rental property broke, but I got this $8,000 deduction. So how much am I going to save in taxes? I'm going to answer zero. You will save nothing in taxes. That $8,000, that is a capital improvement. It needs to be depreciated over the life of the unit. So they will realize absolutely zero tax benefit by spending $8,000 on a rental property because they make over $250,000. Those passive losses cannot offset any other active income, such as W-2, retirement, interest, dividends. It's only when you make under $150,000 is when you can start realizing some of your passive rental losses. You are able to deduct a lot more expenses than you were when it was just your primary. Okay, when it was just your primary, you get mortgage interest and property taxes. When you convert it to a rental, you can now deduct the HOA fees in addition to the mortgage and property taxes. You can deduct utilities. You can deduct management fees. Pretty much any dollar you've put into that rental property while it's a rental property, it can come off and offset your rental income.
What about vacancy?
So, vacancy is on the owner. You do not deduct rents you should have received. All right, we've determined they want to be landlords. They determined they want to create some passive income. They determined they want to have this for a longer time. And I say, okay, well, let's talk about worst case scenario. Your renter decides not to pay you and you're not receiving any rental income, which means you have to float your primary mortgage and the rental mortgage. And the question I ask is, could you float both comfortably for 6 months? And I've had people say, oh, absolutely not. I need that rental income to pay for the rental mortgage because I don't have it from my free cash flow. That's going towards the primary. And then our decision is this too risky of an investment for you? Okay, because you can't just say, hey, I'm not getting rents, get out. Depending on your state, depending on the knowledge of the renter, they may be able to stretch it out for 6 to 8 months in the court system before they vacate your property.
Even
And that
longer than
could
that
put you
in a lot of places.
even longer than that.
What I always tell people is if you're a landlord, you can account for about 80% of your rent. A lot of people think they're going to, oh, I'm getting $3,000 a month, so they count the whole 3,000. That's not realistic because you're going to have vacancies, you're going to have breakdowns, you might have a bad tenant for whatever reason. 80% is the rule that I use when I'm telling people that they can figure, on an average per year. But I just want to take the example you gave. A recent example I ran into was family that was, their kids they're empty nesters. They've been in their
Mhm.
family house for 20 years. They owned a beach house that was their summer house.
Mhm.
Now they have a primary that they lived in Bethesda, example. They want to move out to their beach house. They have a huge capital gain on that Bethesda property. Strategy wise, it's something for them to look at is it worth converting it to moving out to switching their primary to the beach house, converting it. But this is something you can't just decide today to do it and think you're going to be able to sell it tomorrow. You have to,
Mhm.
what was it? 2 out of the last 5 years.
2 of the previous 5 years, it has to be used as your primary residence.
So they have to be in their beach house for 2 of the 5 years. So it's at least 2 years. So in their case, they weren't really concerned about what the rent, they could float, just the example you gave, they could cover the entire 2-year period without getting any rent because
Mhm.
of the position they were in. They were protecting a huge capital gain that they wanted to look at rolling into 1031, other vehicles to keep their money working for them and not give it away. So
Exactly. Yeah. So with that situation and considering tax planning and the 1031s, the starting point is always the gain. Okay. So maybe you can say, hey, let me figure out if I have a gain on this property. And let's say your gain is 50,000. That's not worth it to do
nope.
for a 1031 exchange. Okay. Let's say your gain is 750,000. Just
There
like
you
big,
go.
like big example you gave. Okay.
Yep.
And they're like, man, if we don't have to, what are ways that we can get around paying this gain? One of the
Legally.
ways
This is all legally. This is
Yeah.
not.
Yeah. And for that situation, they move out, they convert it to a rental. Okay. If it is rented for, let's say, 5 years, okay, they have now, they lost the $500,000 capital gain exclusion. Okay. So to our point that we discussed before about thinking of if we're going to convert it to a rental or not, you need to realize, am I going to lose that capital gain exclusion? Right. So if you convert your property to a rental, you have 3 years to sell it before you lose the $500,000 capital gain exclusion. I like to play conservative. If I'm truly playing the capital gains deferral game, because remember, we don't avoid taxes. We can try to defer taxes if possible. If I'm playing that game, I'm renting that property for a minimum of 2 years before selling. But in this situation,
Big buck.
you would go into it saying, I'm going to convert it to a rental, and then maybe I'll keep that rental for the next 30 years and my kids will inherit it and they'll get a step up in basis. Or I'll convert it to a rental and I'll do a 1031 exchange, because a 1031 exchange only works with like kind property. You cannot 1031 exchange your primary residence for a rental or a rental for a primary residence.
But I want to go back to that, what you just said. It's like property. They don't have to buy the rent. They don't have to buy the house 2 doors down. They could buy into an apartment building. They could buy into a syndication of an apartment building. So they could go from being a hands-on landlord, going over there, cleaning out the HVAC and working on plumbing, to being a passive, just getting their checks and basically retiring on the income. Is that,
Yep.
am I in the right ballpark?
You're totally in the right ballpark. So your example, big Bethesda house that they've had forever, $750,000.
Small Bethesda house that in a big lot.
Big lot, right? So they're going to come in and somebody's going to buy it and put 3 houses on that lot, right? So in that situation, here's in a perfect world. If somebody really wants to get into the landlord game, they take that property and they sell it in a 1031 exchange. And let's say they buy rental property that is 4 different rental units. right?
Four
Or
plus.
they buy, anything that is like qualifies for the like-kind property. So now they don't have to pay that $750,000 gain that they would have had to pay if it was sold as just a rental. Okay.
They can keep that for 30 years.
Exactly. They will only pay that gain if they sell the new property at a gain. Okay. So you don't avoid it in a 1031 exchange. You kick the can down the road. But for these people's situation, they are strategically instituting these moves, renting for X number of years, 1031 exchange, converting it into 4 different rental properties, right? And that way they can get this passive income for themselves for the long term. And then you can go even further. What if their kids inherit all of those rental units or that rental building that they bought? They get a step up basis. The kids can then choose to sell the property if they've got the step up, and they will pay little to no capital gains, because if you inherit the property on January when it was appraised at $1 million and you sell it in February for $1 million, you don't pay any taxes. Those are the numbers.
So powerful, but people don't understand. And in this case, with these folks, they ended up going with the Delaware Statutory Trust, and they ended up picking up, I believe, some triple net leases on some major retailers. And they're in a completely different world. They're basically passive investors, as passive as you can get.
You have a major gain that we need to kick the can down the road. Okay, here's how you convert it to a rental. Here's the specific things you need to do to be within the boundaries of the law. And then here's our plan. 2 years from now, you're going to work primarily with Mark to get this property sold. But I'm not the most important one when it comes to the 1031 exchange. Mark is. The realtor is. And here's why. The 1031 exchanges have very, very strict rules if you want to be within the boundaries of the law.
You have to be.
Those rules involve timetables. You have to, once you sell the property, you have to use special intermediaries. So a client says, I want to do 1031 exchange. I'm sending them my referral for an intermediary. Mark will send them his referral for an intermediary. You then have to use a special title company that deals with 1031 exchanges. And you can never take possession of the money. So if you sell that rental property that you've had for 5 years, it needs to go into a special account. If you get the check, you can't do a 1031 exchange.
People, that's so powerful. You got to say it one more time. If they take the money, if there's an intermediary, if there's not an intermediary and they take the money, even if they plan on giving it to the intermediary, the fact that they take the money, deal's dead.
They've lost.
Can't do
capital gains. They've triggered capital gains. Rules of possession of the money. You can never take possession of the proceeds. You have to identify a property within 45 days. You have to then close on that said property within 180 days. I think that's the laws. Don't quote me. And remember, can't rely on that.
Yep, it changes all the time.
Think about that. In this current market that we live in, Mark, we're dealing with multiple offers, raving contingencies. There's no guarantee that you can come to the table with the best offer, because there could be somebody else coming on top of you. So let's say you found that perfect property and you've identified it. It's possible 180 days can go through that you have not closed. Guess what? Capital gains. All that money you've spent to hire the intermediary, the more money you'll pay for the special title attorneys, thousands of dollars to try to be within the realm of the 1031 exchange. Because you have not landed the property, you pay the capital gains. And that's why you need a realtor, because they're the ones that have the technology, they have the knowledge to make sure you take your property from start to finish in the boundaries of that timetable. The CPA can't do that.
In what you just said, you don't identify just one property just because of that, because there's so many obstacles that could happen. Not just that the property's gone. You might be buying it from your friend. It's a great deal. They're not selling to anybody else, but all of a sudden you find title issues and you can't close on it. There's all kinds. So what I always encourage my clients to do is we pick out the properties, put our list together, and then we always have that one. Either it's either a buying into a deal with apartment building deal or some other where that is the backup in case everything else fails and we can't close on a property. We have some place to put our money that's a good investment, that's getting a good return, that qualifies, and that's our back pocket. Because if in this game you make an error, it's going to cost you, and it's going to cost you generations down the line. because you're
Because
talking
we're not
big
talking
money.
about you're talking about your kids' money with some of these long-term investments, right? And don't give it up unnecessarily. So, we've had clients come to us in April during tax time and said, hey, Jeremy, I just sold my house. How do we report it on my rental? How do we report on tax return to do a 1031 exchange? I'm like, well, what do you mean?
You don't have to anymore.
You have the money. They're like, yeah, we have the money. I was like, well, you can't do a 1031 exchange. So that's
It's
why
painful. We laugh
you
about
have
it,
those
but it's so
conversations.
painful.
And I have a client, I was going to say my example was I had a client that did everything right. They worked with the intermediary. They did the special title attorneys. They identified their property. They had title issues.
Yeah.
They found out it wasn't going to happen in 6 months. And he just threw up his arms, was like, well, and they were not able to get another property. They didn't have the backup plans like you. They didn't think like you did with your clients. And they were banking on that one property. And we did planning for him that he's going to avoid all this gain. And now we had to re-go and say, hey, you know how you weren't paying taxes? Well, you need to set aside $300,000 because you have to capture that $1 million gain. We still are paying historically low capital gains rates, and all indicators are that they're increasing. Okay. So in some situations, it's better to lock in the gains you have in a hot market under a current tax code that we know what it is. I think the capital gains taxes are going to increase. We've had 2 administrations previously, both Democrat and Republican, and capital gains did not significantly increase.
This is all, we're just going over hypothetical situations, but they're all based on our experiences and what we've seen and what we've had to deal with. It's so important for folks to, if they're thinking about selling years from now, 2 years from now, if they have a huge gain, you need to really look at it and say, okay, what is my exit strategy? Again, if you bought your house 3 years ago and it went up $20,000, $30,000, you don't have to worry about it. That's a typical sale. But if you're talking big numbers, 3, 4, 5, 6, 700, $1 million, $2 million, then you have to look at it and say, okay, you get what you pay for with a professional.
Exactly.
You don't want to be the person that they're learning on. You want somebody who they've already felt the pain. They've been in the battle. They know something always comes up. We can sit here today and talk and go through our checklist and have seen almost everything. But every deal, there's always
There's always something new. I know.
Always something you're like, wow, I didn't know that.
What I like to say is price is what you pay, value is what you get.
Thank you again for your time and great information. And how can somebody contact you?
Absolutely. So you can go to my website. It's jaquesfinancial.com. So that's JACQUES financial, all one word.com. My name is Jeremy Jaques. Please, if you have any questions at all, don't hesitate to give me a call.
And we'll put your information down in the comment section below. Again, I'm Marc Cormier. I hope you enjoyed this. Stay tuned. We'll have more coming up. Enjoy your day. Take care.
Thanks, Mark. Have a good day.
Bye-bye.